Hi everyone, this is Rob Roy of LA Wave Options. We recently launched our LA Wave Options time strategy, and boy, it seems everyone is curious how it uses AI-based trade signals. So I thought I'd just give you a quick Cliff Notes version of how it works. First of all, exactly what is the LA Wave Options time strategy? It's a service that will send you alerts via email and SMS for option trades on stocks that have experienced a drop in price, and that our AI has identified as likely to trade in a sideways range. We therefore set up trades that are going to profit from option time decay, assuming the stock will stay in a trading range over the next few weeks. Typically we use calendar spreads, but also diagonals and butterflies depending on the price and availability of the options. In simple terms, all of these option trades benefit as long as the stock stays in a range close to its current share price. The new LA Wave Options time strategy came about because we were searching for a better approach for our new option traders. You see, our existing strategies have good, actually great track records, but they are directional strategies where we buy option positions because we expect a strong move in the stock. Let's take this example of one of our actual trades in the stock CFG. We were expecting the stock to move up, so we bought calls. However, often that move doesn't come immediately, and in the meantime, because we bought options, our trade starts showing a loss due to theta or time decay. If and when we actually get the move we've been waiting for, the trade becomes profitable. You can see this trade made 109%. However, if you're a new option trader, sitting through all the red ink in your account is super hard, and we've noticed that a lot of people really can't take it at first, so they stop trading. Therefore, with the time strategy, we wanted to set up trades that avoided this problem. So let's talk about option time decay for a moment. If we draw a chart representing the effect of time decay on an options price, it will look like this. We have our option price on the vertical axis and the time until the option expires along the bottom. We'll set up markers every 30 days starting at 120, which is about 4 months from expiration, until we get to 0, which is the day the options will expire, worthless. Now here's the thing. Options do not expire in a straight line like this. Rather, the time value of options expire more quickly as it gets closer to expiration. As you can see, it looks like a curve. In other words, options lose most of their value in the last 30 days, and we're going to use this to our advantage. We're going to sell an option that's going to expire soon so that as that option expires, we begin to profit because we can buy it back very cheaply, or better yet, let it expire worthless and keep every penny that we sold it for. But wait, I hear you say, isn't selling naked options risky? Well, the answer to that question is yes and no. We don't want to take that risk, so we also buy a second option to cover our risk. However, we use a different option to offset that isn't going to expire until a longer period. Our option number 1 is expiring soon and will expire quickly. But option number 2 still has months before expiration, so the rate of time decay is slower. Therefore, we'll make a greater amount of money from selling option 1 than the protection of buying option 2 will cost us. You see, the amount we profit in green is larger than the amount we lose in red. Buying these two different options is called a calendar spread or time spread because it takes advantage of the different amount of time to expiration in the two options to profit. As long as the option price stays within the range between the strike prices, the calendar spread will be profitable. So very importantly, to make this work, we need a stock that stays in a trading range. And here's an example of what happens when you get it right. This is a real trade example from the LA Wave Options time strategy. It was trade number 489 on the stock TWLO. As you can see, the stock dropped and then traded sideways, which gave us a great profit of 78% in just 21 days without having to sit through a period where we had big losses on the trade. So that's exactly the type of trades we're setting up with the time strategy. Obviously, it doesn't always work out perfectly, and some trades are losers. But overall, we're trying to identify these sideways stocks And that's where the AI comes in. Years ago, I noticed that very often when a stock drops on the basis of bad news or a negative earnings report, that it sits and trades sideways for a while. I thought if we could identify these type of stocks, it would be perfect for our new time strategy. I had an initial idea for a scan, and when I began working with the guys at Hub to put the scan into their software, they offered to use their new AI technology to see if they could improve the trades that were selected. We took my initial idea, but added over 300 different pieces of data for the AI to consider around each trade. And the outcome blew me away. What we've developed is completely unique and so much more sophisticated than the traditional backtesting that you may do with technical analysis. In summary, we asked the AI to look at all these stocks that experienced significant drops and work out how to identify the ones that would most likely trade sideways. Because many of them don't. They bounce back up or they head lower. We need the ones that'll stay in a trading range. Now, I do not profess to be an expert in AI by any means, so I'll give you my layman's explanation of what the algorithm is doing. The AI algorithm is a form of technical analysis, but way more complex and sophisticated than any human could manage. Instead of looking at a few trend lines and indicators on a chart, the AI is considering more than 300 different points of data for each trade candidate, and many of these are rankings of stocks across thousands of other stocks in the markets. As I said, I don't understand all the details, but essentially the AI is looking at all the relationships and correlations between these points of data that forecast a higher probability that the stock will continue to trade sideways. These are some of the actual data correlations displayed on scatter plots that you can see on the screen at the moment. As I said, there's just no way a human could do all this analysis by looking at a chart. So let's talk about the results. We gave the AI 20 years worth of stock data from 2001 to 2021. The AI was able to identify 7,562 candidates for trade opportunities in this period and rate them on a scale of 0 to 1. Think of that as 0 to 100%, with the high score indicating a higher probability that the stock would trade sideways over the next 21 to 30 days. We then took the AI recommendations and did an analysis on how accurate this was. The results are shown on the scatter plot below. The bottom index is the AI score for how likely the stock was to stay within a predefined sideways range. The left-hand index shows the percentage of stocks that successfully stayed within that range. Now, you don't have to be a statistician to appreciate that this data shows a very clear trend. Let's draw a line of best fit through these points to show the trend. What it very clearly shows is that the higher the AI ranks a stock as likely to stay in the range, the higher the chance that it successfully stayed within that range. We decided that we wanted to have an expected win ratio of 2 out of every 3 trades, so we therefore targeted a 65% level of accuracy. This corresponded to an AI score of greater than 0.75 to select trades. In other words, we're going to take the trades that the AI rates 0.75 are better. The other interesting point is that even if we select 0.75, which is a pretty high bar, we can still expect a significant number of trade candidates as this distribution shows. As you can see, there's still a large number of total signals to the right of this threshold. Now let's talk about the actual trading results. We finished testing and started tracking results in September of 2021. As at the time of this recording, we've been trading for 4 months, but we update them on the website every month so you can check for updates. The other thing we found was that the activity was largely driven by earnings announcements. We also generated some interesting insights. And to be clear, the AI was not given any information about earnings. So it's finding these opportunities just by looking at the chart patterns. We found that 56%, so just over half of the trades, did arise as a result of the price reaction to an earnings announcement. 29% occurred on other news between earnings announcements, while 15% were trades that were set up prior to an earnings announcement and held through the announcement. As we've already mentioned, November was the most active month for this strategy, corresponding with more earnings activity. And also, interestingly, this chart shows the win ratio based upon the trade's position relative to earnings. Trades in between earnings were 90% successful, while those held through an earnings announcement were less successful than the average. I guess that makes sense, as a market reaction to earnings can be volatile and more likely to move the stock out of the trading range. So, I believe that gives you a pretty good summary of what the new Elliott Wave Options time strategy is all about and how we're using AI to run the trading strategy.